can see at least the handouts. Great. I'll just move this here so I can see the chat box just in case. Hey, Twana. I wish you could see the screen. I don't know what's going on. Yeah, the screen's for those of you that are online, the screen is off here in the smart classroom. It worked just fine for the daytime meeting at the Kent campus. So this is my first time using this room. So at least the WebEx is working, so that's good. But if you want to see the handouts, you can look on my screen. Actually, maybe I could do this. Maybe I can. Oh no, I guess I can't turn it. Oh, I know. I have an idea. I can do this. I can turn it so you can see the screen. There you go. Hopefully it doesn't fall. There we go. Now everybody can see the screen. So welcome to tonight's meeting. I do always like to get started on time, and we have a couple of good topics that were suggested over the last couple of months that we'll go over, and I think it'll be a lot of fun. But first, before we start, are there any topics, and I'm going to get my little notebook out, are there any topics that you want to suggest for next month's meeting? Feel free to type it in, or if you have an idea, I'll just write it down in my little notebook. I actually didn't come up with any ideas for the daytime meeting, but I always like to start out asking just in case you have any suggestions to talk about for next month. This month, we're actually going to be going over a really popular topic from previous meetings, which is some things to look. Hey, welcome. I'm sorry I can't get this screen to work, so you can't see my handouts, but I have a small screen, so you can at least see the handouts on the little screen. So feel free to take a look. Oh, duh. We don't even need the screen because I printed them out. There we go. Problem solved. I knew I printed out. Here's the sign-in sheet, by the way. So that I know you're here, and here is the handout for today. That's for to share. And then this is the agenda for today. So, and this is the other. So just take one of each, and you'll be one too, I think. Great. Now everybody has it. The only thing you won't be able to see is like when I go over like stock stuff on the screen here. So you'll just have to look on the screen later. Okay. Well, great. So if you have any ideas for topics you want to talk about next month, just let me know. All right. Great. So we're going to go ahead and get started with the first topic, and this one's really popular topic. We've talked about this one before, but it's a good topic anyway to repeat, and it's what are some things to look for in an underlying stock. And so let me go ahead and I'm going to share this screen with the people online that are with us. All right, so if you look at the very first one, and I put it right at the top, for me, the most important one is liquidity. And that is the most important criteria that I've learned from probably one of the best traders I know, who's the CEO of Tasty Trade. Liquidity is the most important. And what do I mean by that? And you could, and those of you that are sitting in the room here, you can look on the screen in a bit, but I'm going to go ahead and pull up the internet so that way I could show you what I mean.
Oh, Kristen, hush, you gotta be quiet.
Window. Yahoo Finance is very easy to use, very user friendly. All right. So if you want to look on the screen here, then you'll be able to see what I'm doing. So even though it's a smaller screen. So what I'm going to do here, and those of you online can see me, how do we tell if a company is liquid? Usually I look for like at least 1 million or 2 million shares traded every day. And so I'm going to show you a very liquid company. And actually, let's pick Apple, since I sold some Apple today. Okay, so Apple, and I'll make this a little bigger so you guys can see it. How do we tell it's liquid? The number you want to look for is volume. See how the average volume? So usually hey, come on in. For some reason, this screen's not working, so you guys are to see what I'm seeing. The only thing I can get it to show up on is the little screen of the little touch screen. Yeah. Now all the people logging into WebEx can see what I see. Okay. But it's just the folks that are in here, and it's my first time using the room, so I don't know how to get this thing to talk to this. Yeah. At the fintech, yeah, in Kent, it just was automatic. So I don't know why it's not automatic, but nevertheless, you got the handouts anyway. Yeah. So when you're looking for liquidity, you're looking for this number here, volume. And so usually, if I want to tell if a stock's pretty liquid, I'm looking to see if there's at least 1 million, 2 million shares traded each day. Apple is a good example of a very liquid stock. Today, there were 46 million shares traded, almost 47 million. Average volume is about 50 million shares traded today. So very liquid stock. And so the question is, why do we want a stock that's very liquid? And the reason why we want a stock that's very liquid is because the more liquid it is, the fairer the price that we get. We should be assured that the price that we're paying or the price that we're selling it, like I sold shares of Apple today, I knew I was going to get a fair price because with liquid stocks, there's usually a very small, very small difference between what people are willing to sell the stock for and what people are willing to buy the stock for. So like in this example with Apple, if you can tell, you look at the bid and the ask. Of course, this is kind of skewed since it's after hours, but let's see. Oh yeah, we'll do the close and the open. So let's see if I can look for a good example. Well, Apple should be a good example. During the day, the bid and the ask, there was about a $1 difference. So similar to this close and open, $247, $248. Usually you want like just a dollar difference between what people are willing to pay for a stock and what people are selling the stock for. So a highly liquid stock should have a very narrow bid and asks, and that's called a spread. The spread is the difference between what sellers and buyers are willing to buy and sell the stock for. Now, in contrast, I'm going to show you a stock that's not liquid. And so you can see the difference. So let's look at Berkshire Hathaway. This is Warren Buffett's company. So with Berkshire Hathaway, hey, come on in. We're having an issue me showing what's on my screen to the big screen. So there's a oh yeah, that's true. If you log into the WebEx link, you can see what's on my screen. That's true. And you can log into the WebEx link actually on any of these PCs too. So if you have the WebEx link from the email, so that way you can see what everybody's looking at on the WebEx. Oh yeah, there's a sign in, and I have actually paper handouts, the old-fashioned way. It always works. And how it works. Yes, because sometimes the electronics don't work. So if you're logged into the WebEx and and you can see Berkshire Hathaway. It's very illiquid. It's not a liquid stock. Berkshire Hathaway, there were 1,900 shares traded today. Not very liquid at all. It's a far cry from 1 million shares traded. And because it's not that liquid, there's a huge difference between the buying price and the selling price today. For example, the bid price was 747,150 for the buyers, and then the sellers were selling at 749,604. So that's about, I guess, a $1,500 or $2,500 difference between the buyers and the sellers. So it's such a wide gap. Hey, come on in. This is my first time using this room, this smart classroom. For some reason, the big screen is not on, so you can't see what's on my screen. However, if you have the link from the email for the WebEx, you'll be able to see it. So everybody online can see it. It's just not the folks in here. I also have handouts of all the handouts here too. So you have the paper copies. And I turned this around, in case you guys wanted to see it. But, yeah. So, but again, the WebEx link's probably the best bet because you'll be able to see it clearly on any of these computer screens. You can just log in. All right. So yeah, we just started with the first topic. And if you have any topics you want to suggest for next month, let me know. I'll put it in a notebook. So Berkshire Hathaway, very illiquid. Very few shares traded, very large spread between the buying and the selling price. So that is the opposite of what we want to see. A lot of times, like with penny stocks are not that liquid, so you're not going to get as fair a price. So liquid stocks, generally you have a better chance of getting a more fair buying or selling price when you're buying and selling a stock that you want to trade with. All right. Going to the next bullet point on your handout, it's called market capitalization. So generally, I try to stick with at least a mid-sized company to a large-sized company. So when I'm talking about market cap, we're talking about companies that are at least $1 to $2 billion worth or more in value. Generally, a large cap company is going to be $2 billion, $2 to $10 billion or more. But at least mid cap, because these companies, there's a reason why they're worth $1 billion or more, because they're selling products and services that people are probably going to buy for a while, regardless of what the economy is doing. So there's a reason why they made it to $1 billion valuation, because they're selling those products. They're probably not going to go out of business anytime soon, versus some small company that maybe doesn't have a track record yet. But not to say it couldn't get there, but if you are investing for the first time, you probably have a better chance of passing the SWAN test. Anybody ever heard of the SWAN test? My students know. The SWAN test means the sleep well at night. So if you know you're investing in a company, you want to be able to sleep well, knowing that the next day you didn't lose all your money investing in something pretty special.
I did sell it a lot.
Yeah, exactly. So I mean, and I've had to harvest losses too, but generally you don't want to do that. So market cap, $1 billion or more. Now, how can we tell if a company is worth $1 billion or more? Well, let me show you. So let's look at another one of my favorites, Microsoft. And when you look up the summary page on Microsoft, the number that you're looking for is here. And actually it is called market cap. So market cap for Microsoft is $2.95 billion. So it's been kind of struggling recently. So let me just make sure my meeting folks are still in there. Oh, okay. Yeah, I want to check. What is the difference between Class A and Class C stocks? Excellent question. Let me show you an example. So we have, I guess the only example I can think of, at least off the top of my head, for Class A and Class C are Goog, which is Alphabet, and similarly, its sister stock, Google, Googl. So both of these market caps, again, $2 billion companies. Class A versus Class C stocks. Now, that's one of the questions from the online attendees. So a Class A stock, hopefully I get this right. Usually sometimes I swap them, I can't tell which, but I think the Class A stocks are ones that have voting rights. So for every share that you own, you get to vote in whatever the board of directors has on the agenda. Class C stocks, they don't have voting rights. It's more of a tracking stock, but doesn't mean it's not a bad investment. I mean, I have shares in both Google and Google, so and they track pretty closely. So hopefully that answers your question. It's really just voting. Do we determine that from market capital? No, actually, it would be the corporate charter, Nikki, is what determines whether they're a Class A or Class C stock. So when they first came out for the first time, then basically that's what the board declared it as voting and not voting. You notice that there's a Class B stock out there too, but it's not publicly traded, and that allows the founders of Alphabet to have some control. So they have super voting shares. Let's see. So market cap again. You're looking for at least 1 billion or more. Large cap ones. Now, Alphabet, of course, they're one of the biggest companies in the world. They're in the trillions. So that's a big capital T right there. So $2 trillion company. So they're probably going to be in business for a while. Price per share should not matter if you're buying quality. And that's the nice thing about modern apps today, with Trade and Go and Legal and Robinhood. Oh, that's all right. Is it echoing? Well, that means the speaker's working. That's good. I'm glad the speaker's working. So let's see where. Oh yeah, price per share shouldn't matter. There are a lot of great companies out there, but then you take a look at their prices. For example, great example. Let's look at one of the ones I just started adding to this month. I'd owned Netflix for a while, but I hadn't added shares of Netflix until just this month. So at the beginning of the month, for the last couple of years, I've been putting $100 into Alphabet, $100 into Amazon with my first paycheck of the month. And the nice part is, even though these share prices are valued at more than $100, I could just buy pieces of them. I could buy fractional shares. So because even though it's expensive, don't let the price or how expensive a stock is deter you from buying a good quality company that makes a good product. So even though those shares are expensive, I'm going to buy pieces of them every single month. And then those pieces eventually will add up into whole shares. So Netflix, good example. Right now they close and they've been kind of dropping a bit. I don't know why. Well, I think it's just sentiment with the market overall. $977 a share. Last week they were over $1,000 a share, but I bought $100 worth of it because I think it's going to be a great company. They are the behemoth when it comes to movie and television production. They have more cash than any other streaming service, so it's really hard to compete against Netflix. And then the other stock I pivoted to is Meta last month. So again, I noticed that Meta is probably going to be one of the leaders in AI going forward, and the stock price has reflected it. They were not today, but they were over $700 a share. So Meta Platforms. So even though the price is down, I'm still going to be buying shares of that. And the nice part about me putting $100 each month into these, despite the fact that those share prices are pretty expensive, is that I take luck and I take timing out of the equation. So I don't have to worry about, well, when do I buy it? How much should I buy? Well, if you're disciplined enough and just put the same dollar amount at around the same time every month, that technique is called dollar cost averaging. Because as long as nothing has fundamentally changed about why you wanted to buy the stock, like for me, I'm going to like Meta at least going forward. I'm going to like Netflix going forward. And as long as I still like them, if the price is down like they are this month, then I get to buy bigger pieces when the share price is cheap. If the price happens to go up when I buy it at the exact same time of the month, that's okay. That means I buy less shares when they're more expensive. So you don't have to worry about timing. Overall, as long as the stock is one that you still like, based on your research, the average price should go up over time. And because you are using this technique of dollar cost averaging, the average cost for you is always going to be lower than what the actual price of the stock. So now, if something changes about that makes you not like the stock anymore, then you might want to switch to something else. But for now, the two that I'm buying is instead of Amazon and Alphabet, it's been Meta and Netflix, and that may change later down the road. So, but for now, I'm just going to add to those. I'd actually owned Meta many years ago when they went public, and I sold it like a year later. But then that's because I bought Apple, so it was a good swap. But this first time in a few years that I'm buying Meta again. But I'm confident that they're going to be one of the leaders in AI. See if there's any questions from our online folks. I'm investing Apple for 2 or 3 years. Oh, great! You must have been getting in at good prices, especially Tesla. I'm actually holding on to my Tesla. I'm not going to sell it, but I haven't been adding to it. But Apple is one that I've had for a while. But I liquidated some of my Apple shares today to raise some cash. All right. Next bullet point, stick to simplicity. Jack Bogle, one of the founders of the concept of mutual funds with Vanguard, and Vanguard's like the biggest mutual fund company, basically just believes in sensible allocation into high quality stocks. And that'll help you sleep well at night. Balance risk, return cost. Does the company have increasing revenues, increasing profits? Look at their cash flow. So this is all part of something called fundamental investing, where you actually care about what the company does. You care about if it's profitable or not. Let me show you an easy way to research that. So if you go to, and let me just look at go back to Netflix, because this would be a good example. When you go to the summary page, you'll see the little menu here. And again, I'm just using Yahoo Finance, but other finance sites will be similar. I'm going to click on the financials link. And when I click on financials, you'll be able to see their income statement, their balance sheet, and their cash flow. So it's hard to fake revenues, top line. So Netflix, why do people want to buy the stock? Well, why am I interested in the stock? Well, take a look at their revenues. How much cash are they generating? Or sales are they generating? $29 billion in 2021, $31 billion in 2022. $33 billion in 2023, $39 billion in 2024. That's a nice trend of continually increasing sales each year, right? And hopefully it'll be great once they do their quarterly reports in 3 months from now. And then what about their earnings, their actual profits? So you could scroll down to the bottom line. Notice their earnings per share. So we've got $11.55 a share in 2021, dropped down to $10.10 in 2022. That's okay. Jumped up to $12.25. So basically that's like a 20% increase. And then look at this huge jump here, which is probably why the stock took off from $12.25 per share to $20.28 per share. And at the end of 2024, that's big. That is what is that? That's $8. So that's probably around a 75% jump in their earnings. So that's good. You want to see things like that. Of course, as a finance guy, you want to take a look at the cash. Hard to fake cash. How much cash are they? Now, just because they are spending cash doesn't mean that's a bad thing. Because sometimes you like to see businesses spend cash for building infrastructure or capital expenses to try to get the business to grow. But let's see what Netflix is doing. If you click on the cash flow statement, you can look at their ending cash position. So 2021, $6 billion, 2022, $5 billion. Then 2023, their cash went up to $7 billion for the year, and then almost $8 billion in 2024. So that's significant. That's a nice trend of cash. You like to see that, when you're shopping around for companies to buy. Of course, my favorite way of making cash while I sleep or playing my Xbox is dividend. So every week I'm getting dividend payments that are going right into my brokerage account, and then I just transfer that out. Or for me, at least for now, I've been reinvesting 100% of that into buying more shares of some of the same stocks. Of course, in a few months, I'll probably be living off of those after I leave, but I'm going to keep on making it grow. Now, when I travel Southeast Asia, I'll probably be living pretty cheaply, so I'll probably still be able to reinvest that money for a while. So what do we talk about dividends? Dividends are basically the share of the profits that the company can pay you in cash. So and they pay that from their income. So as long as they're making money, ideally, hopefully they're making money, then they're going to reward you for buying their stock by paying you a share of the cash. Now, how do we know if it's worth it? Not all companies pay dividends. Some of my favorite stocks, Netflix, Amazon, they don't pay a dividend. Alphabet, which is Google and YouTube, they didn't start paying a dividend until like about a year ago. So for the longest time, they were reinvesting all their cash back into growing the business. But Amazon does the same thing. They don't pay dividends. They want to still grow. But some things you want to take a look at if you're shopping around for a stock that pays the dividend is how often do they pay? How much? What is the yield? What percentage of their profits are they paying? Is it sustainable? So how do we take a look at that? How do we find that out? Well, let's take a look at a couple of dividend payers. Let's take a look at Apple first. So Apple is kind of a growth company. And if you go to the summary page again, the number you're looking for is right here, forward dividend and yield. And you're going to get two numbers. One is a dollar amount. So that's $1 in cash. So for every share of Apple I own, I'm going to get $1 as a dividend every year. And the one in the parentheses is the yield. So again, it's pretty low. And this is the equivalent of like the savings interest that you would get in a savings account at the bank. But don't be fooled by why it looks so low. That's a function of two things: how much cash it pays out and how much the stock price has grown. So if the stock price keeps going up in Apple, that causes that yield to go down. I'm totally okay with that because I'd rather have the stock price at Apple keep going up because that's going to continue to build my wealth. And then I get paid a dollar while I wait. But if you go to something like Pepsi's not a sexy company, but people still like to eat and drink junk food, so they'll be in business for a while. So let's look at their dividend. Their dividend, look at that. That's huge relative to Apple and Microsoft. $5.42 per share for Pepsi stock. That's translates to a 3.5% yield. I mean, that's better than probably what you're getting on your savings account. But can you imagine? I mean, for every share of Pepsi that you own, you get $5.42 for doing nothing. That's pretty nice. Now, granted, Pepsi's stock price is $156. They had a good day today. A lot of defensive stocks had a good day today. So how do we know it's sustainable? What you want to do, and we're kind of digging a little deep here in analysis, you can go back to the financial statements and compare how much they paid in dividends to how much their earnings are. Because remember, that's where your dividend comes from. It comes from their earnings. If they have earnings, they'll pay a dividend, and that'll reduce their cash. So how do we find that? Dividends is a financing cash flow, and I can drill down here. So in 2024, they paid $7.2 billion in dividends. So what do they earn in income? We'll go back to the income statement. And so for 2024, they had $9.1 about 9.6 in income. So if I take just a simple calculator and see how good that number is, so 7.2 billion divided by 9.6 billion, that's 75%, which is kind of on the high side. Let's see if there are any questions out there. All right. It's kind of on the high side. That means they're paying 75% of the income that they earn and returning it back to the shareholders. So that's really, really generous. But it may not be something that you want to see. Generally, I'd like to see maybe 50% of their earnings returned to the shareholders or less. And the reason why is twofold. One, if they don't pay as much to the shareholders, that means they got more room to give you a raise. So if Pepsi's paying you 75%, there might be less of a chance that they're likely to give a raise because they're already paying so much back to the shareholder. But if they still have a small percentage, they can give a raise. Another reason why I don't like to see it too high is sustainability. What if Pepsi has a bad year and they've been paying 75% of their earnings to shareholders, but they need that cash to keep the business going? Then they may have to cut the dividend in order to keep or preserve the cash to be able to operate. Well, if they do that, what do you think is going to happen to the stock price when the investors hear that they're cutting the dividend? Yeah, it's going to tank. Investors hate the fact. Even if they decide to keep the dividend the same, if they've been raising it for 25 years and they said, we're just going to give you the same dividend we paid you last year, stock's still going to tank. So you want to see that sustainability. A lot of real estate companies pay some high dividends sometimes, and you always have to wonder, is it sustainable? Also, take a look at how often they pay. When Walt Disney, I think they pay every 6 months. Most of the companies that you've probably heard of, Coke, Pepsi, Microsoft, Apple, Home Depot, Target, Lowe's, they always pay every quarter. If you do your homework, though, you might be lucky and find some stocks that'll pay you once a month. Realty Investment Corporation, which is letter O, is the stock symbol. Their nickname for the company is the monthly dividend paying company. So the more often you get paid, the more you can use compounding to grow your money. I actually have like a little notebook to where I've got it a whole schedule down, so where I know what stocks are going to pay me in the first week of the month, and I take all those dividends and buy shares of the stocks that are going to pay me in the second week of the month. And then I take those dividends and I use it to buy shares of the stocks that are going to pay me in the third week of the month and the fourth week and the fifth week. So I kind of have this snowball effect going on each week. So you can find them out there. Also, even though stocks pay you once a quarter, they pay you on different months. So you can have a stock that'll pay you in January, April, July, and so forth. And then you can have you can buy a stock that pays you in February, May, August, and so forth. So you can artificially create a dividend cash flow where you get cash every single month. You'll just have companies that pay you on 4 times on different months of the year. But if you do that, then you can have cash flow coinciding with your bills, which is pretty nice. Another next bullet point relates to what do they do? Do they make products and services that sell regardless of the economy? This is part of fundamental investing. This is when you actually care what the company does. So you're interested in the products and services, their competitive environment. I call it being market aware. How does external stuff affect your company? Can inflation affect your company? Like high interest rates, that can probably affect a lot of real estate companies or home builder stocks, because that's going to make their homes probably less attractive, and so those stocks might suffer. Or if you hear high inflation numbers, who might suffer from that? Well, retailers. Retail stocks might not do as well because people are less likely to shop around and save more money if inflation is still high. Changes in management, maybe new technology. Is the company being sued? One of the things that I've been kind of bearish on Boeing, you hear all this bad news the last couple of years about their planes keep on crashing, or the door to their plane busts open or something like that. I mean, they just had a news report just this week where I think it was from Atlanta to Tennessee or something. Some flight had to be diverted because there was smoke in the cabin. So I'm betting that Boeing stock's probably not going to like that. Miguel had a question. Could a high ratio indicate a company is not investing in its own products? It is possible. You kind of have to look at the management's discussion and analysis section of their reports to see if that's the case. It could simply just be that the board makes it a policy to reward the shareholders with a high dividend, and maybe they haven't identified enough capital investment to divert some of their dividend cash to investing back in the company too. But it's more likely you see a lot more mature companies that have been around for a while start to have their dividend ratio or payout ratio be a little higher. So that's possible too. Another thing that you could do when you're shopping around for a stock, you can take a look at charts. So we're getting more for the technical side of investing. Let me go back to the summary page. There's basically two schools of thought when it comes to investing. There's fundamental investing and there's technical investing. And I kind of like both. There are ones, and there's one group of a proprietary trading firm called S&B Capital up in New York, and those guys are some of the best technical traders that I've seen. And the fact that their lessons are very easy to understand, but they trade mostly on technicals, patterns. They look for patterns in stuff, regardless of what the company does, regardless of what they represent in their financial statements. They're just looking for patterns. And so when you're taking a look, let's say at Pepsi, I usually when I'm trading, I like to look at least the last couple of months to see if there's a trend. But a lot of true traders, they look at the daily changes in the middle of the day of the stock price. I'm not that meticulous, nor am I trading by the hour either. So you can actually look like Pepsi, kind of have a trough here. So year to date since January, looks like it's made a nice comeback. But if you take a look over the last 52 weeks, Pepsi is kind of stuck. It had a high of the 180s back in May, and it's down in the 150s today. Although, again, it's creeping back up since the beginning of the month, so that's not a bad thing. Hopefully, it keeps on going back up. But I don't have a position in Pepsi right now, so but it's an easy one to take a look at. So you could take a look at trends, and you can select different intervals. You could do a 1 month chart. I actually have a custom one in my trading platform where I do 2 months at a time. So 1 month for free sites like this, it'll give you 1 month. But if you have any brokerage account at all, you could set up a lot of different indicators for free, how you want to do it. Let's see. Next bullet point, beta. So again, we're looking at another indicator, but the reason why I like to share this one with you guys is that it's super easy to understand. And on the summary page, you can see beta is right here. Beta for Pepsi is 0.55, a very unsexy stock. So let me explain what beta means. So the stock market, the 500 biggest companies, or the S&P 500, is a beta of 1 by default. So the market itself is defined as a beta of 1. So what beta tells us as an indicator It represents how volatile our stock is relative to the market. So Pepsi has a beta of 0.55. That means it's not that volatile. Risk profile is a little lower. And all it means is if the stock market goes up, Pepsi stock would go up too, but not as much. If the stock market goes down, Pepsi stock might go down too, but not as much. So the beta of less than 1 means that it's not going to move around as much as the market. Generally, that you could interpret that as a less risky stock. So let's take a look at the opposite of that. Let's look at Tesla. Notice that Tesla's beta is a whopping 2.34. So if the market goes up, Tesla stock may go up quite a bit. But if the market goes down like it has over the past week, then Tesla stock is super tiny, which it is doing exactly as expected, sadly. So if you take a look at just the 1 month chart for Tesla, not looking good. You look at the year to date, yeah. I mean, it had a peak of 428. Now it's down to barely 300. Geez, that's painful to watch. I have shares of Tesla, so I hate to see that. Definitely not adding more to that. So that's beta. Let's take a look. So we know. There's also negative beta. Not that that's a bad thing. All a negative beta stock means is that it'll move in the opposite direction, which actually may not be a bad thing to have in a portfolio. Because if the market goes up, then a negative beta stock goes down. But if the market goes down, especially like it is now, a negative beta stock will go up. So I have several shares in a negative beta ETF, which has sadly been having a good week because a lot of the tech stocks have been going down. So it is designed to move in the opposite direction. I basically just bought those as a hedge because if the market crashes, then those shares should shoot up way up in value, and then I'll just disappear. But yeah, so there's negative beta output. Again, just moves in the opposite direction. And then the last technical here, which is a little more advanced, but I'm going to show you a simple technical indicator that's super easy to understand. And that's the 50 and the 200-day moving average. So let me show you here. And we'll keep Tesla up here on the board. On the summary page, I can just expand the chart here to a more detailed chart. And I'm going to add a couple of indicators. So I'm going to add, and I'm going to click on indicators. And I just want the moving average. Here we go, moving average. And I'm going to add a 50-day moving average. I'm going to make that, we'll just keep it as the red color. And so the red indicator here, and let's see if I can get we'll do a 1 year chart. Or maybe year to date. Yeah, year to date. 3 months. So the red indicator is the moving average. So every single day, they're going to lop off the oldest day and add the latest day. So on average, this is the movement of Tesla stock over the last 50 days. Now, to make it useful, I need to add one more indicator, which is the 200-day moving average. I'm just going to type 200 days. So I want a longer or longitudinal average. I'm going to give that my favorite color, which is purple. And there we go. So yeah, so notice that for a long time, the 50-day moving average was higher than the 200-day moving average. But what you want to take a look at is where they cross. So generally, if the 50-day moving average crosses above the 200-day moving average, that indicates like a bullish signal. It means there's a possibility that the stock might go up. But you want to give it a couple of cycles to see if that's confirmed. Because another indicator that you can look at is if the 50-day moving average drops below the 200-day moving average, that is a bearish signal. So there's a possibility the stock will go down, and it looks like it did right when it crossed. So, and the 200-day moving average stayed above the 50 for quite a while till, there was a little breakout, I guess, after the election. So again, as a technical indicator, that's probably one of the easiest ones to use. And even if that's the only one that you know, that'll probably cover about 90% of all the technical indicators you really need. There's a nickname for these indicators. If the 50-day crosses above the 200, the nickname for that is the golden cross. And if the 50-day indicator drops below the 200-day average, then that's called a death cross. And so really easy to understand, death is going to be bearish, the golden is going to be bullish. But again, you want to give it a few cycles to make sure it's confirmed that the trend is. So you can use that as useful buy and sell points if you wanted to trade in the stock. So if you can confirm and it's sustained that the golden cross is for real, then it might be a good buy. If the death cross is for real, then either if you have a position, it might be a good time to sell, take the profits. Or if you don't have a position, maybe short the sell. Make money with the assumption that the stock price is going to go down. All right. Well, we got one more topic to go, and this one's a little short, but a really good topic, actually. AI stocks other than NVIDIA, which was suggested at last month's meeting. So what I did was I went ahead and looked, because I actually built a list of AI stocks to trade into my trading platform. So I can screen just for AI if I wanted to trade AI for that day. So what I did was I took most of the stocks in my AI watch list that are not NVIDIA, and I put it in the Word document here. So feel free to research, and I'm not going to explain all these, to research like their stock price movements, see which ones kind of fit within your budget, look at what they do. Like TEM is one of the newer AI stocks for materials. I think the reason why TEM is interesting is not necessarily because of what it does, is who bought it. Nancy Pelosi, which is a very famous congressional member of the House of Representatives, is notoriously known for being really lucky at stocks, being a member of lucky at stocks, being a member of Congress, and making tens of millions of dollars based on what she buys and sells. That's one of her latest buys. So, which happens to be an AI stock. And big coincidence, the stock has actually gone up. Wow. It's like she knows something. I don't know. I'm not accusing her or anything. I think she's just really lucky. If you look at like the top 3 investors that are members of Congress, she's usually 1 or 2. So not that you need to copy her trades, but she seems to be doing really well for herself. Considering a congressperson's salary is only like a couple $100,000 a year, but she's like a multi-millionaire since she's been in Congress. So
He has a good advisor.
yeah, she does. Her husband. SMR, that's an energy company. A lot of AI companies these days, especially the big boys like Alphabet, Microsoft, they need power generation to power a lot of the servers. So they are contracting out for, literally whole nuclear plants to be able to power their systems, and SMR is one of those companies. Same with Texas Power, that's TPL. A lot of the big boys that you're familiar with are AI stocks also. Netflix, Meta, Microsoft, Amazon. Arista Networks, which I bought several years ago. That one's been great. That's a networking company. Palo Alto Networks, that's PANW, that's a cybersecurity company. ServiceNow, we have AMD, they make chips. They're actually a competitor to NVIDIA. Of course, Tesla is an AI stock because, again, besides solar panels and rockets and Boring Company and cars, they make robots, and that's one of their newest things. Palantir is an interesting one, another AI company, but they're known for Department of Defense government contracts. So I bought shares of Palantir, been pretty happy with that. Oh, I forgot one. SMCI, Super Microcomputer, should be on this list. So SMCI, you could write it down. I'm actually going to type it in here, because I forgot to add it to this list. The Super Microcomputer is another one of them. I've been reading the stock for the past month. Yeah, Tem. Yep. Yeah, Tawana says same thing. Of course, Apple. Salesforce. Salesforce was just added to the S&P 500. So that's another big company that's using AI for their human resources systems. Even financial companies are into AI. Visa, that's V. IBM, of course, has been in there since the beginning. Taiwan Semiconductors, that's TSM, one of the biggest suppliers of chips. Of course, there's Google. ARM Technologies, I love ARM. ARM Technologies, they only went public in the fall of 2023, but I got in at like 35 bucks a share. I think it was going to probably be at least the highest was like 160 a share in just 2 years. Why did I buy ARM? Again, this is a fundamental investing where I actually did the homework on what they make. Their chips are in about 99% of all the smartphones in the world. And so without their chips, what they do is they license their chip technology to the manufacturers, like NVIDIA and Samsung and all those. So the chip technology is licensed, and they earn money from the licensing of those chips in almost all the smartphones globally, including the ones that are only in other countries. Fortinet, that's security, Dell Computers we've heard of. Dow Corning, GLW, they make like the materials. Of course they make like the stuff that's in your cooking pans or stuff like that, but they also provide the materials for a lot of the fiber optics used in the internet. AIQ, there's Intel in there. SoundHound, although I can't really recommend SoundHound because I think NVIDIA sold all their shares in SoundHound, so they divested away. So that stock's not been doing great. But yeah, this is a good sample of at least to get you exposure to AI if you want. But again, do your homework before you put any money into these. See what they do. See what the stock does. But again, at least this should give you some ideas. But other than that, we're going to leave on time. But thanks for coming out. We had a good turnout tonight for the nighttime. Better turnout than the daytime meeting, actually. Pretty awesome. Again, if there's any suggestions for topics for next month, just feel free to text or email me, and I'll add it to the list. Although I still have a lot of topics suggested in previous months, so we got plenty of suggestions. If you haven't signed the sign-in sheet, or just make sure I got your email, and you can read it when I get it. But I guess since you're here, you probably got the email. So. So thanks everybody, and I'll see you next month. I will still be running the meetings. I know that Dr. Walker should be taking over the club after I'm gone, so he'll probably start in the fall because we always take summer off. But I'm physically gone this summer. I mean, I'm locked in. My plane ticket's already bought. I'm flying out July 1st. So, but I'll still be teaching online then. Yeah. I got a couple of my house sits set up. I signed up for trusted house sitters, so I'll be house sitting for 3 weeks at a couple of homes, one in Wales and another one in England for a couple of weeks. Be a lot of fun. The best part is saves on hotel costs. I just have to watch their pets and keep the house all nice and neat, and it's free rent. Nice. Yeah. Like I bought my Trusted House Sitters membership on Black Friday, so the membership was cheaper. Oh. And the fact that I've already booked two house sits, it's already paid for itself. Yeah. And then I'll be flying out, and then thanks for remembering. Appreciate it. Thank Absolutely. You. Yeah, I'll be taking a one-way boat ride back to Florida in November for Thanksgiving, and then I get to do the Southeast Asia leg. of the traveling. So I'll be nomadic. I'll spend a week in the Philippines with my dad, and then probably spend a month in Cambodia, Vietnam, Thailand, maybe Malaysia or Singapore, and then I'll decide if I want to apply for my residency in Portugal. Portugal was the original spot, but I figured, well, once I apply for my residency, I can't leave the country, so I'm gonna get some traveling.
Yeah. Retired early. Nice.
Yeah, hey, that's what dividends and investing. That's what investing early does. Yeah.
Pay attention to this.
Hey, students should do it. Yeah, I tell my students all the time. It's like it's a lot less painful to start early. I mean, I literally started when I was still in school. It's like I'm glad I did because now I don't have to wait so long.
Yeah. Nice. Awesome. Thanks, Randy.
Thanks everybody. Yeah.
Good options on the stock or the futures?
Yes, each are different. So the features are leverage contracts. I haven't traded features yet. I'm still teaching myself, but I've been doing options since 2017.
Okay.
So I like options, but I'm still buying stock. So I'm still buying stocks in the PSC, but options is just a different way. It's like buying and selling insurance contracts and stuff. Is a good way to compare it.
Because my question is still saying if you buy stock or sell it, you just wait. Wait.
You just wait till it grows.
Yes. But
Yeah,
if you buy
but with options you can get more immediate profits. You can see the money faster. There's a window because they expire. There's a date of expiration. Same with futures.
So what futures issue is so that it's a margin. So they
They're a margin.
bonds, futures, two or sales and but they change price every day. And
Right.
you
Now-
can't get hold of it. It's not about money.
That's you have to have a lot of capital.
Option.
For regular futures, you need a lot of capital to trade.
Yeah.
However, they invented mini futures. Yeah, the mini futures, so it won't require as much capital. But even newer than that, you can trade options on the futures too, which I haven't taught myself. Which requires even less money.
Yeah, exactly.
Yeah, so I wanted to learn that, but I haven't given myself enough time to learn it fully because I don't want to go into it when I'm not fully educated on it yet. So I want to thoroughly do more training in it before I actually put my real money.
Yeah, I can.
But I think I gave you good websites for the training on the options part.
Yeah.
Yeah, so keep on with that education, and then that will be helpful.
I found got them like file exchange.
Oh, yeah.
They have like engagement and they have like
Yeah, it should all be free.
yeah, it's free and they have like book or then I can send it to you on the way. And you can learn a little bit Java. So they explain options.
That's very useful.
On the WTI live.
I like that.
They have like 3-4 minutes like videos from there.
Oh,
And then
that's
like go and you
It
can
makes it easier to learn.
yeah.
Oh, I love it.
It's like more information. Like,
Yeah, feel free to email it.
Yeah,
I love it.
because then it's like official information. So okay, thank you very much.
Yeah, how are you, sir?
Good.
My question,
It's gonna be cooking dinner when I get home.
my question is a little different.
Yeah.
I finally got a chance to try to catch one of your classes before you leave.
Oh, good. You actually got yourself on the roster.
Yeah, finally got it. It's online, of course.
Of course, yeah.
Yeah.
That's just the way
I think
the way they all are.
I think it's 1 of May.
Yeah.
And
Oh, yeah, that's fully online.
yeah, and online is not my best.
It's not my favorite either, but
But-
that's just what most of them are these days.
What can you recommend that I do in order to try to make preparations so I don't